Canada's economy just slipped into reverse. The latest GDP print went negative. This is such a clear sign that the so-called resilient economy lie told to you by the media is just that, a lie and a facade. For ordinary Canadians, this isn't just a headline anymore, guys. It means fewer jobs, slower growth, and a government that is running out of room to prop up this debt-driven economy. And if GDP continues to print negative, something has to break. The proof is out there, guys. The media will tell you one thing, that our economy is resilient and is doing just fine. But then the banks, one of the largest business models in Canada, will turn around and tell you something completely opposite. Here, from the TD Bank, one of the largest banks in Canada, was their recent post about this GDP contraction. They said GDP contracted 1.6% in the second quarter. Lower than consensus, but right on target for their prediction. Guys, the banks know the trajectory of Canada's economy. The banks know this, and they will still look you dead in the face and tell you, buy more bonds. Buy the bonds, buy the GICs, buy the 60-40 portfolios. They know GDP is sluggish. They know the mechanisms the government will use to stimulate. They know bonds will underperform. They know bonds will lose money. And still, they tell you to buy. GDP growth, the last 6 quarters. You can see here, we got absolutely crushed this quarter for a multitude of factors. Here we have a composition of what the GDP print is made up of. And there are a few things that jump up at me right off the bat. The first one being our exports dropping over 2% in the second quarter. Now, when I see that, the first thing that comes to mind is our over-reliance on a single trade partner. Now, we touched on this in a recent video I just dropped where we kind of looked at the Canadian economy a little more in depth. And that was one of the biggest signs I pointed out in that video, was our over-reliance on the US. About 75% of our exports, of all our exports, go to the US. Now, if you've been living under a rock, which I frankly don't blame you if you have been, the US has initiated this massive trade war with the globe, slapping tariffs on everybody, including Canada. And if your main export partner hits you with a 25% tax on those exports, of course they're going to drop. Now, the other thing that stood out to me was investments are falling. And this is a common symptom of nations in late long-term debt cycles. Something called capital flight, where businesses, sovereign wealth funds, big money no longer sees Canada as a profitable investment. They no longer trust it, so they remove their capital. They no longer invest in businesses, they no longer hold Canada's debt, and investments begin to drop, which we saw in this GDP print. And what we need to understand about Canada, guys, is that GDP, at least nominal GDP, can oftentimes be manipulated, such is the case when we live in a fiat currency world and there's nothing backing our currency, there's nothing attaching our currency to the laws of Mother Nature. When this is the case, numbers begin to lose meaning. And a lot of the times with GDP prints, you can bolster them, you can manipulate them via fiat currency. However, that only lasts for a certain amount of time before real life effects start to show up in the data, which is what we have here. It was Canada's most recent job report. Jobs are down over 60,000 across the country. Unemployment is about 7% now, which is just a crazy number. That's a crazy number. For a country in the G7 to have an unemployment rate of 7% is absurd. So maybe, just maybe, GDP isn't actually what we thought it was. And maybe this print in Q2 is an actual reflection of the underlying dynamics going on in Canada. So what can we do about it? More specifically, what can the Bank of Canada do to help support and manage this irresponsible fiscal behavior? Well, we've talked a bit about it on the show. It's been a very big theme on the channel. It's been a very big theme, a prominent theme in Canada's financial landscape, and that is repression, guys. We can see it here. TD, yet again, saying the quiet part out loud. TD Economics gradually expects the Bank of Canada to ease the policy rate to 2.25% by mid-2025 and hold it there until 2027. Those are not my words. Those are the words of TD Bank, everybody, one of the largest banks in Canada. And if we know what financial repression is, it is when policy rate is held artificially lower than inflation for an extended period of time to erode the value of debt burdens. My friends, inflation is well over 3%. Unemployment just hit 7%, and the rates will come down to 2.25%. Now, I told you earlier, one of the symptoms in a long-term debt cycle near the end is capital flight. That is other nations around the globe losing trust in a nation to pay back the debt in a currency that has held its value, and whether or not that nation is a profitable business. Now, how does that manifest itself in the market? Well, one of them is capital flight, which we saw in the latest GDP print composite. And the next, brought to you by one of the OGs of finance YouTube, Mark Moss, the central banks are losing control of the long end of the curve, ladies and gentlemen. The other way losing trust in a nation manifests itself is in the bond market, where yields start to rise, and when governments have large debt burdens, high yields is not what you want. You can see that here in Canada's 10-year. It has started to tick up along with the US 10-year. Ladies and gentlemen, there is trouble in the bond market. And when governments have billions and trillions of dollars of debt to roll over within a year, within this year alone, they do not need rates high. I'm talking 3.5 to 4.5+%. That makes their life miserable and a living nightmare. So what do? Mark Moss, yield curve control coming to a market near you. What does that mean? It means the banks, the central banks, will step in to buy government bonds to suppress the long end of the curve, to keep rates artificially suppressed below inflation, guys. And what does this do? This affects the currency in a negative way. It devalues the currency. It pulls purchasing power away from you and I, so the government can support its irresponsible spending. Now, we've seen this chart again on this channel a lot. It is the Canadian USD pair. This is the only outlet the Bank of Canada has, and they will use it as much as they see fit in order to gain control of that long end of the curve. The dollar will be devalued. Inflation will run hot and rates will come down. I tell you guys this at the end of every video. If you want to save your purchasing power, you need to exit the system. This is already happening across the globe. The BRICS nations are making an epic rotation into neutral reserve assets, gold and Bitcoin. You can do that at an individual level. You can take your stupid, worthless fiat paper and convert it into something that maintains value, that holds value over time. We now have the choice on an individual level to opt out of the system. Buy yourself some Bitcoin, save your purchasing power. If you guys enjoyed this video, drop a comment down below, drop a like. Make sure to hit that subscribe button. I'm trying to build a channel here, help educate you guys and myself on finance, on macro, help navigate me and you through this turbulent time. As always, I will catch you guys in the next video.